Welcome to the deep dive. Now, if you're in financial services, maybe especially captive finance dealing with leases, you know the easy accounting. That's the stuff that's clear-cut, certain. Today, we are really wrestling with the hard stuff. Those financial obligations where, the timing, the amount, maybe even if you owe the money is uncertain. Our mission here is to cut through the complexity of IAS 37. That's the standard on provisions, contingent liabilities, and contingent assets. We want to give you a kind of strategic roadmap for recognizing and measuring these things. We've looked at the materials, the guidance, and honestly, the biggest risk seems to be booking expenses too early, what people sometimes call blanket provisioning. That's really the trap we want to help you sidestep.
That's a perfect way to put it. IAS 37. It's less about just ticking boxes and much more about exercising critical judgment. And because it is so judgment heavy, if you misunderstand those core definitions, especially what a provision actually is, well, you can end up with really significant overstatements of liability. And that causes unnecessary volatility in the financials. So we absolutely have to start by getting the terms right. Precise definitions are key.
Okay, so let's start right there. What is the difference between just any old liability we owe and this specific thing called a provision?
Right. So a provision is technically a liability, but one where the timing or the amount is uncertain. That's what makes it different from, say, a simple trade payable where you know exactly when and how much. But, and this is crucial, for it to actually be a provision you recognize, three things must be true. It has to stem from a present obligation, which itself comes from a past event. And importantly, it must be probable that you'll actually have an outflow of resources, cash usually, to settle it.
That probable outflow bit sounds like a major gatekeeper. Can we maybe drill down on what probable means in this context? Is it like 90% certain or?
That's a great question. Probable outflow really is the main hurdle. In practice, it's almost always taken to mean more likely than not. So think greater than 50% chance. If it's, 50-50 or less likely, it doesn't meet the definition of a provision you'd book. And to actually get it onto the balance sheet, the standard IAS 37.14 lays out three non-negotiable tests. You absolutely have to meet all three.
Okay, so what's the checklist? Give us that trifecta we need to satisfy.
Okay, first, a present obligation has to exist. Now, this could be a legal one, something right there in a contract,
Right.
or interestingly, it can be what's called a constructive obligation.
Constructive, what does that mean practically?
It means the company, through its past actions or stated policies, has created a valid expectation in others, like customers or employees, that it will actually pay out or settle something, even without a strict legal contract for that specific instance. Think established patterns of behavior.
Okay, so present obligation, legal or constructive. What's number two?
Second is that outflow is probable. That more likely than not test the greater than 50% likelihood we just talked about.
Right, got it. And the third?
And third, you must be able to make a reliable estimate of the amount. You need a reasonable basis for the number. If you meet, say, the first two, but you just can't reliably estimate the cost, maybe it's a complex litigation where the outcome's totally unknown, then you cannot book that provision, even if you think you'll probably lose.
Huh. So fail just one test, and even if you have this sort of shadow obligation hanging over you, it doesn't hit the books formally. What happens then? Where does it go?
Exactly. If it fails even one test, it gets categorized as a contingent liability. Now, contingent liabilities are still really important because they require disclosure. You have to describe them clearly in the notes to the financial statements. So they don't impact your balance sheet numbers directly, but believe me, auditors, investors, analysts, they scrutinize those notes very, very carefully. This split between recognition on the balance sheet versus disclosure in the notes, it's fundamental.
Okay, that distinction is clear. But then, let's say we do meet all three tests. We have to book it. Now we need a number, a dollar figure. Given the uncertainty baked into the definition, how does the standard stop this just becoming, management's best guess?
Well, it demands diligence, not just guessing. The rule is you record provisions at the best estimate of the expenditure required to settle the obligation at the reporting date. This isn't just pulling a number out of thin air. It has to be a considered estimate, taking into account the risks and uncertainties surrounding the obligation. You need a methodology. You also have to factor in relevant future events. So, for example, if you're provisioning for environmental cleanup, you need to consider if new, maybe cheaper technology is expected that could affect the final cost. And this is really critical for finance companies with long-term items like leases. If the time value of money is material, which it often is over several years, you absolutely must discount that estimated future outflow back to its present value.
Ah, the discounting requirement. That definitely adds a layer of complexity, but makes sense for long timelines.
It does. It prevents you from overstating the liability's current impact by recognizing future costs at their face value today. It's about reflecting the true economic costs now.
And it sounds like this isn't a set it and forget it kind of entry either. These situations change, right?
Absolutely not. The standard is very clear. Management must review all existing provisions at each reporting period end. Balance sheet date rolls around, you reassess.
And adjust them up or down.
Yes, adjust them up or down to reflect the current best estimate. This ensures the balance sheet is always reflecting the most up-to-date assessment of that probable future outflow. It's a dynamic process.
What about reversing provisions? Say that risk goes away entirely?
Reversals are allowed, of course, but management needs to be careful. A reversal should only happen if there's been a genuine change in the estimate or the probability. Maybe the feared event didn't happen, or a lawsuit was won, or costs came down dramatically. What you can't do is just slowly bleed the provision down over time, like a kind of planned amortization, just because time has passed without a real change in the underlying facts or estimates. The reversal needs justification.
Okay, this theoretical framework is clear. Let's try to make it more concrete. Let's talk about some real-world scenarios in captive finance. This is where the judgment really comes into play, isn't it?
Exactly. This is where the rubber meets the road. Let's start with some fairly common ones. Think about dealer rebates and incentives. Many captives offer dealers bonuses based on sales volume or other targets. The obligation to pay the rebate builds up as the dealer makes sales. So you'd recognize a provision if hitting those performance targets looks likely probable based on current performance and forecasts, and you can reliably estimate the payout based on the agreements and maybe historical data. That ticks all three boxes: obligation, probability, estimate.
Okay, that seems straightforward enough. What's another common one?
How about self-insured products? A classic example is maybe excess wear and tear coverage that the captive offers directly rather than through a third-party insurer. Here, you'd book a provision if claims are probable based on your historical data on how many customers actually claim and what the average repair cost is, and you can reliably estimate that total expected payout across your portfolio. The past data gives you the basis for probability and estimation.
Right, this makes sense. Now, here's what I know causes some confusion, and it's really important for getting the accounting right overall. Separating different types of risk. The materials we reviewed highlighted losses from things like fraudulent lease originations, identity theft, fake income documents, that sort of thing. Operational failures, really. These aren't about the customer's ability to pay later on, which is credit risk. So these fraud losses, they're not covered by IFRS 9, the standard for expected credit losses, are they?
That's absolutely correct. It's a critical distinction. IFRS 9 deals with the creditworthiness of the borrower. Losses due to outright fraud at origination or perhaps significant operational errors by the company itself fall outside of that.
So if not IFRS 9, where do these operational or fraud-related losses get accounted for?
They fall squarely under IAS 37 if you meet the criteria. The key here is often the constructive obligation part. If, say, internal control failures within the captive allowed the fraud to happen, and the company has a history or policy of effectively absorbing such losses rather than pursuing every single one, that can create a constructive obligation. Then, if you determine that such losses are probable across your originations and you can reliably estimate them, IAS 37 is your standard. You'd need a provision for expected fraud losses separate from your IFRS 9 credit loss allowance.
Wow, okay. That forces a very clear separation in how you model and track different kinds of potential losses. Credit risk versus operational risk?
Precisely. It ensures you have distinct frameworks and don't improperly mix operational failures into your credit loss calculations. Clean accounting requires that separation.
Okay, let's shift to what seems like the really high-stakes challenge mentioned in the sources. Timing. This seems to be the main reason for that warning against blanket provisioning. Let's unpack the tricky provisions for potential shortfalls, starting with the GAP insurance. How does timing work there?
Right, the GAP insurance shortfall provision. This is a classic example where intuition can lead you astray. You might feel the risk the moment you sign a lease that includes GAP coverage. But IAS 37 is strict about the past event creating the present obligation. For GAP, the obligation for the captive to potentially pay out doesn't actually arise until the total loss event occurs. The car gets written off, and the primary insurance payout is less than the outstanding lease balance. That's the trigger event. So booking a provision for potential GAP claims across all your new leases at origination would massively overstate your liability. Only a small fraction will ever actually experience a total loss.
So the better practices.
The better practice is to estimate your provision based on the existing portfolio, using historical data on claim frequency, how often total losses happen, and the average GAAP shortfall amount when they do. You're provisioning for the risk pool you currently have, not speculating on day one for every single new lease.
That makes sense, delaying recognition until the obligation crystallizes more clearly. Now, what about the really big one for captives? Residual value, RV, shortfall provisions. This is where the captive guarantees a certain value for the vehicle at lease end, but the market might tank and the actual auction value is lower. That feels like a loss waiting to happen from day one. But again, the sources strongly caution against booking a huge upfront provision at origination for every single lease that might eventually come back. Why is that intuitive approach considered wrong or likely to overstate things?
It comes back to that probable outflow test again. At least origination, it's usually not probable that every vehicle, or even a majority, will result in an RV loss. Think about it. A good chunk of customers might buy the vehicle out at the end of the lease, especially if the guaranteed RV is attractive compared to the market. Others might return vehicles where the actual market value ends up being higher than the guaranteed RV, resulting in a gain, not a loss.
Right, so the loss isn't a certainty for the whole portfolio.
Exactly. The probable loss only really materializes for a specific, often much smaller, group of leases, those you genuinely expect to be returned and expect to have a market value below the guaranteed RV. So the preferred approach, the one that better matches expenses with revenue and risk, is to delay the main RV provision. You should only recognize it when those outflows become probable and reliably measurable. This usually involves sophisticated modeling based on your expected return volume for different lease cohorts, and then estimating the likely shortfall specifically for that group, considering current market conditions, forecasts, and how close those leases are to maturity. You align the timing of the provision with when the risk actually becomes probable for identifiable groups of assets.
So it's about refining the pool you're provisioning for and timing it closer to when the market outcome is more predictable, preventing that big premature hit to earnings based on speculation.
That's the essence of it. You achieve better matching. You recognize the expense, the cost of that RV guarantee more closely in time to when the revenue from the lease was earned and when the actual market risk manifests.
It sounds like getting this right requires really robust forecasting and portfolio analysis, constantly updated.
Absolutely. It's not simple, but it leads to much more accurate financial reporting.
Okay, so wrapping this up, the core message from IAS 37 seems pretty consistent then.
It is. It really boils down to the diligent, simultaneous application of those three key tests. Is there a present obligation? Is the outflow probable? And can we make a reliable estimation? And crucially, avoiding that common pitfall of blanket provisioning, setting aside funds before the loss is actually probable according to the standards definition.
So for you listening, the strategic takeaway seems clear. Your task is to draw sharp operational lines. Carefully distinguish your IFRS 9 credit loss modeling from your IAS 37 provisions for operational stuff like fraud or those RV and GAAP shortfalls. And always, always strive to make sure your expense recognition truly matches the timing of the risk you're incurring.
Exactly. And maybe one final thought to leave you with, since we've stressed how judgment-based this all is, because you're relying heavily on internal models, historical data, future predictions. The real sustainable value for your organization isn't just getting the number right today. It's in continuously improving your internal review processes and critically, meticulously documenting every single assumption that goes into your estimation models. That documentation, it isn't just for the auditors. It's the backbone that proves your judgment was sound, reasoned, and applied consistently over time. That's where the long-term confidence comes from.